Hi, welcome to this live webinar from Private Partnership, where we're looking this week at what and when is income gains become taxable, and where is it taxable. So we've talked in this series about the income being taxable in different locations and how we can use split year rules to manage a return. But it's not just about using the split year rules and about the residents and the non-residents. It's about what the type of income is, and that's what we want to focus on today. So what type of income and when is it taxable? If you're joining us on YouTube, welcome. At the end of this questionnaire, if you're a retained client, we can go into slightly more detailed, specific questions and answers. So the essence is looking at what type of income that we've got for our income, our dividends, and our gains as a business. Last week we looked at split year rules, and we'll cover that in some instances here, but we'll take it slightly differently. So there's two types of incomes that you can have. There's movable and immovable. So some incomes, some taxable entities move with you and some don't. This varies by jurisdiction. So it does change. You have to bear that in mind. And it depends upon the double taxation treaty. So all tax law around the world is generally covered under OECD regulations, creating international templates. Double taxation treaties are no different. And then those are defined country by country. So to make up slightly different rules for different situations, depending upon what that may be. So let's look at pension income for starters. So with the latest version of the standard double taxation treaty, it allows for a country to tax publicly sourced pension income at source, even if an expat is living and working abroad. So America and Canada have done this for years, where state pensions from public service work have been taxed at source, and it's not available for relief overseas. And this is now available in other double taxation treaties, and the UK have updated with some jurisdictions around the world. And that means that if you've got a public service pension, be it military, NHS, civil service, or local authority, or any other government-owned source pension, those pensions can always be taxed in the UK as income for the rest of your life. So even if you go expat, they're still going to be taxed in the UK. Now, if you have a 12,500 public service pension from the UK and you go to live and work abroad, that could be a good thing, because that 12,500 is your personal allowance in the UK, and therefore you'll pay no tax in the UK, and then it's not reportable in your other country of residence. So Cyprus pensioners with UK state pensions from 24-25, unless they elect otherwise to do it slightly before, will be paying UK tax on that income. But then if you've got £20,000 of UK sourced income, yes, you will pay tax in the UK as a pensioner, but you won't pay tax on any additional, that won't be reportable in Cyprus. So a retired expat could come to Cyprus with a public service pension to be taxed in the UK, but then they've still got the equivalent of £17,000 personal allowance in Cyprus that they could use against other pension or investment or earnings overseas. And this extends to other jurisdictions. If you go to a jurisdiction where there's no local taxes, then you'll pay only tax on your UK pension income if it's a public service source one under under the latest form of double taxation treaty. So pensions are not always the same as they are. That they're being reviewed and changed with updated double taxation treaties. So even going to live in a nil tax location for retirement isn't necessarily going to mean that public service pension is going to be tax free. More information and guidance. Retained clients can ask us on live using our live chat service, accessible from our website at productpartnership.com. So if you want to retire, subscribe, join us at productpartnership.com and look for live chat. Takes you to our retained client service, and you can book free reviews and appointments online, chat with us, and subscribe there annually or monthly for full service or the new light retained client service. So we look forward to seeing you on the other side for that. So pension incomes can have special rules. In addition to that, the next level that we look at is end of the general income. So if you're earning income, got any earned income, there's two things about that. Is that generally it can be taxed where you are, but if it's an employment, it's where you're economically active. So and that could also bring in social insurance liabilities as well. So if you relocate to Portugal and you work in Portugal, even under the non-resident schemes, you'll still pay local Portuguese tax and social insurance on that income and that earned income. If you go to a country like Cyprus, they have a system where as long as you're in the country for 60 days, and remembering that as a tax resident, you've got to have a permanent resident for the whole 12 months, and you're then working abroad for 10 months in Africa or the Middle East or another jurisdiction, you don't pay any tax in Cyprus on that worldwide earnings. So you can have a tax resident in Cyprus be working abroad either as a nomad or crypto investor or a Middle East African worker where you've got a zero tax, local tax contract, and effectively pay no tax on your worldwide earnings. So Cyprus is quite a good place for that. And in the current scheme of things, very attractive for Russian technology individuals, nomads, small businesses, and larger companies that are looking for a jurisdiction to be tax efficient in the EU and low taxes on their overseas earnings. So income is earned where it is, and you pay social insurance as well, and that moves with you. If you've got royalties coming in, if your business has got a royalty that's being paid to you, or if you've got royalties on your publishing or written music or other rights that you've sold, those incomes become movable as well. So if you relocate to a jurisdiction, what tax are they charging on that royalty income? Is it part of your income, or is it a tax at a special rate? So different jurisdictions can have a flat rate tax. So Bulgaria, Romania have flat rate tax systems. So does Portugal for taxable income, worldwide income. What flat rate tax can you pay? So on a royalty, it could be a flat rate tax of 10%, which is attractive to an expat. That whereas in the UK, royalties can add to your total income to total up to be to actually your highest rate of income. So royalties on movable income. If you're a business and you've relocated overseas as a business person and you've got a holding within the business and you've lent money to your company that's being paid back to you as an interest, that interest that's paid to you is movable as well. So any interest that you're receiving from your investments is taxed in the country in which you're resident. So if that's the UK, it's the UK. If it's overseas, it's overseas. Now, a country like Cyprus could be very bad to receive interest because interest is taxed at 30%. But for non-dom expats, they pay no tax on dividend or interest that's earned. So if a business person has got an interest that's being earned from the business, then that is taxed in the country in which you're resident, not in the country where it arises. So you can have interest from your business in Spain or Portugal or UK, and it's taxed where you are. So that's another way around that. Dividends, again, it's a movable income, so it's taxed where you are tax resident. And again, repeating this point that a tax residence is determined by you having a country that you're tax resident in. You've got to have a resident visa for that. Post-Brexit, that's not an automatic right in any EU country as it is for any other country around the world. So you have to establish the local residency permit rules, and that involves having a permanent resident in that jurisdiction where you're living permanently with utility bills to get the tax residence. Those are needed not just to secure your tax residence and your expat tax savings, but also to allow your banks and your investments to work as well. So you need to have that residence and to get that tax residence abroad. So there are important factors for you to consider, and in taking a relocation abroad when you go expat, about where your income is going to be taxed. If you want to look at your individual circumstance, then contact us at proactpartnership.com and we'll give you that deeper insight. You can live chat to us or register as a retained client to receive online advice during your relocation and for tax issues as you're living and working abroad. Capital gains is a slightly different issue as well. And there's quite a number of different situations in different jurisdictions. Essentially, a capital gain is taxable in the country where the capital gain is. So if you've got a property that's in the UK, then of course that's fixed asset in the UK. It's going to be taxed in the UK or when that tax arises. But with residential or commercial property in the UK, that capital gain is fixed to the UK. That doesn't move. So even if you go expat, you're still going to pay the highest rate of capital gains tax on that. So yes, you have a personal allowance for capital gains each year, but there's still going to be a capital gains on building property and commercial property in the UK, whether it's residential or commercial. There's plans that expats can make when you're buying into the UK, but you need to consider that with us at another time by contacting us at proactpartnership.com. So, or joining us as a retained client on our live Facebook chat, which will go live after this YouTube video. Other types of capital gain in the UK have got tax advantages for expats. So if you've got a business that you're going to sell or you're going to go public, like Matalan, John Hargreaves did at Matalan, if you've got a business that's going public, or if you've got a business you're going to sell, or you've got a valuable asset that you're going to sell, or you've got a crypto investment portfolio that you're going to sell out of, then all those things are big opportunities for you to go expat and potentially save any capital gains tax in the UK. So capital gains tax in the UK on investments, shares, private investments, company investments, is taxed up to 20% at higher rate taxes. Same with crypto. Any crypto trade, it is a capital gain. You can't draw income from crypto. So whether you're banking profits, whether you're changing the currency holdings or flipping an investment, that creates a gain. So if you're an active trader, there's a potential that you can take action to be deemed a trader in the UK. But from a capital gains perspective, any gains, any moves that you make, you do become a tax. It is a capital gains, and it's a liability in the UK. Now, if you go expat, business sales, valuable asset sales, investment sales, share sales, crypto sales, after you go expat, are capital gains tax free. But it's important to remember that two things, and again, it depends upon the individual double taxation treaty. But for a capital gain to be exempt, you need to be expat and non-resident before you incur the capital gains. So it's not sufficient to go expat in July and then sell the shares or the investment or the crypto in August and get capital gains in that current year. It won't work. Even if you're split year, generally doesn't work. You have to go expat and be expat before the start of the tax year, before you make the conscious decision to start selling the asset, instructing agents, instructing brokers, instructing lawyers, instructing finance or investment companies, making inquiries with them. You have to be expat. You have to have your residency visa and your tax residency status and your tax number set up in the year before you go expat. So before the 6th of April this year, you must be expat to then make sales in 2022-23 and save capital gains tax exemptions. If you apply for a split year during the year and seek to protect your trades, none of your income before the split year starts is free of UK tax consideration. But also, all your gains from the 5th of April to your split year are still potentially liable to tax in the UK during the current year, because the decision to go expat is taken retrospectively and it's seen as a sham scheme to avoid the capital gains. So generally, you won't get away with that. And that was reinforced in February when Matalan lost a case that when they went public from private ownership, the owners tried to go expat and argued that they were expat before the capital gain was realised. And HMRC won that up to 20 years to collect £130 million of tax. So it's an important timing decision to go expat and have your residency and your tax residency established before making a capital gains decision. Remembering that with split year, the income does work. So if you've got interest and you've got dividends and you've got being received beforehand, I'm just starting the live Facebook feed for the question and answers at the end of this seminar now. So prior retained clients can join the live Q&As at our exclusive private group. If when you go split year, dividend, royalties, and income earned after the split year date are taxed in your new country of residence. So if that is a more beneficial tax saving opportunity, then that can work for you. If you're operating through your personal service company, then obviously you can time the receipt of that interest or that dividend or that royalty. It's connected with that split year arrangement. Very hard to do that with capital gains, and our caution is to go expat before you start making that moves, to plan ahead. The other alternative is to make a long-term plan with your family and business to use a tax residency that will protect you from tax. So you'll hear us quite often talking about a Cyprus International Trust, which can hold company shares and interests and investments with zero tax liability in Cyprus. So if you build your portfolio of business assets and interest-bearing assets and dividend-bearing assets within a Cyprus International Trust, those can pay you can receive tax-free income and pay you tax-free income indefinitely into the future, and protect that capital asset from not just capital gains. There's no capital gains for Cyprus assets on investments or crypto or business. The only capital gains you can get in Cyprus is on Cyprus property. It protects them from capital gains during your lifetime. And of course, capital gain, the other time you can lose capital gains is on death, but then it becomes inheritance tax at 40%. So again, by building a long-term portfolio where you've got your own family investment company, your own family investment trust, you can have those assets in such a way that you can protect from inheritance tax and capital gains going forward. Capital gains and inheritance tax can be avoided, but only with those long-term plans. So in summary, the income, the capital gains, the interest, the dividends, they're taxed where you're tax resident if they're a movable income, and that depends. But if they're a fixed income, a fixed capital gain, then they're taxed where those income or where those gains arises. With crypto, it's a new market. It's a new set of individual wealth creation, which the tax rules are just beginning to build up to and understand. But essentially, any crypto transaction is capital and not income. Therefore, it's going to be taxed where that capital gain arises. You can go expat and avoid future capital gains, but it's not necessarily the going to protect you against any previous one. And you have to be careful with split year. Split year can save you tax on future dividends, royalties, interest, and income. But during the split year, capital gains could still apply. So that's our broad overview. If you want to go onto the live Facebook group as a retained client, we can give you a bit more detail, a bit more insight. But if you've got any questions for us, contact us at propartnership.com. You can go live chat to ask a question and book a free consultant review with one of our consultants where we review that, and we provide an online service for our clients to guide them on tax, wills, immigration, business, for family and business across border and down generations. I hope you found this interesting. Going forward in the coming weeks, we've got a new tax year starting next week, UK, marked on our product calendar. There've been some significant changes announced in March, and we'll be covering those and looking at what is the highlights of the UK return for any expat that needs to complete a return in the UK, for any gains, property rental income, or other income that's arising in the UK, or for split year going out or returning to the UK. So we're going to cover those issues over the next few months and look at the new tax years and the Cyprus tax year as well for expats who are on an annual tax return basis. Thanks for listening. And if you're not subscribed as a retained client, go along and join us at proactpartnership.co.uk and join us on our Facebook live chat if you have specific questions that you want to ask now. So thank you very much, and we'll see you next time.